This presentation is called, this is our Crush the Market with Options course. We've done this a couple times, but it's a great class, and I'm glad to be able to present it to you again today. So let's get started here. For those of you joining us for the first time, a bit about us here at Trading Wins. We're a group of pro traders with well over 30 years of experience. We're real traders and teachers, and we've been developing our own strategies, and trading systems over the years and teaching people from complete beginners to experts. Now, in today's presentation, I'm going to share with you some of the option basics. We'll spend a very brief amount of time on that, and then move on to why and how you should trade calls and puts, and then talk a bit about trading options during periods of high volatility. We've seen a lot of this lately, and we actually happen to be right in the middle of options or scoring earnings season, and so I'm going to show you the right way to trade earnings, also how to protect your positions with options, and talk a bit about who actually makes money in the options market, and show you how you can do exactly the same. Now, hopefully we'll have plenty of time left over for some Q&A. We'll try to get to as many of your questions as possible. Please remember, though, that trading can be extremely risky if you don't know what you're doing. So please do not trade with real money until you're completely comfortable. Just a few poll questions before we get right into this. Question number one, how many of you, out of curiosity, have seen me present at an event like this or a webinar before? Please, if you can, just type in a quick yes or no into the chat. Just have a couple of quick poll questions, and then we'll move on to this presentation. Great, thank you so much, everyone. That's great. Also, how many of you have actually traded options before? Please let me know if you have, yes or no. Excellent, so it looks like most of you have. Fantastic. Okay, if you haven't, no worries. I'll try to give you as much information here as possible. And lastly, on average, for those of you that have traded options, how many option trades do you place per month on average? Is it 1 to 10, 11 to 20, or are you more active? Excellent, okay. Awesome, all right, so let's get into this now. You know, in the media and everywhere else, wherever you hear people talking about options, there's typically a lot of myths out there, and I wanted to dispel a couple of them for you here today. One very common myth is that options can be very, very complicated to trade, when in actual fact, the truth is that they can be very simple to trade once you know how to trade them, and I'll do my best to give you the basics here today. Another myth is that they can be extremely risky. The risk really comes from the unknown. Once you do know how to trade them, they can actually be very safe. They're much safer than trading stock once you know how to use them. But the real key here is to know when and how to trade them, and that's what we'll spend some time on today. Now, these next couple of slides, I'm not going to go through them in detail. These are just the basics. I thought I'd put them up here so that when you receive the recording, you can pause it and go through this yourself. All this information is available free online. Excuse me. But a couple of things you should know about options. Number one is the premium and how it's calculated. So one option contract is the equivalent to 100 shares of the underlying stock. So for example, if you're buying one call option at $1.50, you have to multiply that by 100 shares. So your total cost outlay would actually be $150. Okay. Now, what type of options can you buy, or what can you buy them on? Well, there's thousands of optionable stocks out there. Actually, it's approximately 4,300 U.S. equities that have options on them, and many of them now have weekly expiries. It's becoming more and more popular. You can also purchase options on stock indices, the most popular being the S&P 500. and also on just about any futures contract, be it oil, gold, wheat, coffee, corn, you name it. You have a wide selection. A few terms that you should be aware of. First of all, in the money. What is this? This is a call option with a strike price that is below the current market price of the underlying, or a put option with a strike price that's above the current market price of the underlying. And out of the money is the opposite. It's a call option with a strike price that's actually higher than the market price of the underlying, or a put that has a strike that's lower than. And at the money is actually the strike price that is the closest to the current market price of that underlying. Intrinsic value, so to every option contract there's two parts to it. There's an intrinsic and there's an extrinsic. The intrinsic is the in the money portion of that premium that you pay for that option contract. So for example, if the call option strike price is 15 but the underlying stock is at 25, then your intrinsic value is 10, okay? That in the money portion from 15 to 25, that is your intrinsic value. Your extrinsic value is actually your time value, which is the difference between an option's market price and its intrinsic value. So it's the second portion of that, okay? And a very important term that you need to be aware of and actually need to know how to use is implied volatility. The estimated volatility of which is the estimated volatility of the securities price, okay, the underlying price. Now, in general, you're going to see implied volatility increase when the market is bearish or in a downtrend, and decrease when the market is bullish or in an uptrend. The reason being is when stocks are dropping, people tend to panic more. So you're going to see the downturns in the market actually develop a lot quicker. Okay, those moves are going to be a lot faster than the move to the upside. So when that panic happens, that's when you see an implied volatility spike. And the opposite, when it's going up, people are calm and relaxed, and the implied volatility comes down. So options are only risky if you don't know how to trade them, okay? But one fact here is that over 80% of all option contracts expire worthless. This is a reality. And most people who trade options only buy options, okay? But the problem is they do so without taking fair value or implied volatility into consideration. So the end result is that they end up buying an overpriced option, okay, and end up losing money even though the underlying stock has actually moved in their favor. Okay? So when you're buying options, there are only 5 possible scenarios for that underlying stock. It can either move in your favor by a huge amount, it can move slightly in your favor, it can remain flat, consolidate sideways, it can move against you slightly, or it can move against you by a great deal. Now, what happens to your to your option price when this happens? Well, if it moves greatly in your favor and you're long an option, you're definitely going to make money. If it moves slightly in your favor, you might make money. What this depends on is that fair value and implied volatility. If you're able to use that and buy a fair priced option, you will make money. If you don't know how to do that, you will lose money as well. Now, if you're long an option and the stock does nothing but trade sideways, you're going to lose money. If it moves against you slightly, you will lose money. And if it moves against you by a great deal, you would definitely lose money. So when you're going long, long an option, at best you have a 2 out of 5 chance of making money. And that's only if you know how to price an option or use implied volatility. Otherwise, you'd have a 1 in 5. Now, when it comes to selling options, the same 5 scenarios are possible. The difference is that if you're short an option and the price moves greatly in your favor, you will make money. If it moves slightly in your favor, you will make money. If it does nothing, move sideways, you'll still make money. And even if it moves slightly against you, you will make money. The only time you will lose money when you're short an option is if the underlying moves against you by a great amount, okay? So, to the flip side, from buying options, when you're selling, you have a 4 out of 5 chance of making money. And remember, over 80% of option contracts expire worthless. That's why this is fact, okay? Now, time decay is a very important piece here. And what you need to know is that when you're going long an option, you want time on your side. In other words, this line here, this gradual slope here, is the time decay. So if you're buying an option, as you're getting closer and closer to expiry, that time decay, okay, the extrinsic portion of your option starts to erode quicker and quicker. And you can see here, the bottom of the chart, most of the time decay happens in the 30 days prior to expiration. So if you're buying an option, you want to give yourself plenty of time. You want at least 60 to 90 days for that option play to work in your favor, and without having the time decay hurt you. Okay, so the goal is to buy an option, 3 or 4 months out, but be out of it before they're less than 30 days to expiration. On the flip side, if you're selling an option, you want that time decay. You want that option to erode as quick as possible as you collect that premium. So you want to short an option. The rule of thumb I use is no more than 40 days to expiration, but preferably 30 or less, because that's when the rapid decay of that time value happens. Okay? Now, there are many option strategies out there. Okay, there's dozens. Long calls and puts, protective puts, calendar spreads, you name it. Even the more complicated ones, butterfly spreads, strangles, iron condors, etc. The key is to understand when and how to use each strategy, okay? But the real key is that you don't need to trade them all, okay? You only need to trade the ones that make you money, okay? So on that note, let's go through a few strategies. There's 4 different ones that I want to share with you today. Strategy number 1, I'm going to show you how you can actually trade Starbucks for $1 a share. Okay, let me bring up my live charts here and show you. Now, I'm going to give you a tip. I do this no matter which class I'm teaching, because this, I think, is something that really puts the odds in your favor when you're trading. When you're trading, what you want to do is find stocks that are trending strongly in one direction or another. And a very simple exercise that you can do is to remove all the indicators from your chart and just look at the price action. Okay? Have a look at that. Now, it's very, very clear what the trend is here. Okay? When you do that, half the battle is won. When you're trading with trend and momentum on your side, that's more than half the battle. Let me give you another example here. There, Valiant Pharmaceuticals. Now, again, it doesn't matter. This could be a strong downtrend. It's the same thing, okay? But when you're trading with trend and momentum in your favor, more than half the battle is won. Now, let's look at Starbucks and go through this example. And let me put my chart layout back on here. Now, with Starbucks, if you're going to buy Starbucks, you think it's going higher. It's currently at 57.07. Which means to buy 100 shares, you're going to have to spend $5,700 for 100 shares. But if we look at the options, okay, how can we pick this up for $1? Well, you can go out here and buy the calls, the $60 calls for October. That gives you 80 days to expiration. Remember, you want to be out before those 30 days to expiration, so you have here 50 days for this trade to work out in your favor, okay? And if you look at the October 60 calls, they're trading between 84 and 87 cents, okay? So you can actually pick it up for less than $1, less than a cup of coffee, actually. And that gives you a 29 delta. Now, the delta is the amount that the option will move for every dollar move in the underlying. So if Starbucks goes from 57.11 to 58.11, okay, that means your option price will increase by about 29 cents. But as it moves higher and higher, the delta will also increase, okay? But it also works the same way against you. If it drops, that's the amount your option will approximately lose, okay? But now, let's look at it this way. You can also buy the stock, okay, and buy a protective put along with it and not risk any more than that $1. Okay, if you were to buy 100 shares of Starbucks at 57.10 or so, where it is now, okay, and you buy the $60 put for 375 to 385, so we'll call it 380. Okay, so 57, 10, and 380. We're talking about just under $61. Okay, about $60.90 or so there. But with that put, you always, between the day you buy it and expiration, you have the right to sell your shares of Starbucks at 60. Okay, so your total cost is $60.90, and you have the right to sell it at 60. So your risk is only the 90 cents. That's it. Okay, more than in the stock along with the put is that if Starbucks is paying a dividend, you get to collect that dividend throughout the time that you hold the stock. Okay, adding to your to your profits. Okay, it also gives you greater flexibility with how you can adjust the position as it continues to move in your favor or even go against you. If we have time, we'll touch on that a little as well. Okay, so that's the advantage of being able to use options to spend much less rather than spending $5,700. You can buy it for less than $1. You can buy this position here for $86 or so. Let's go on to strategy number 2 here. Okay. Oops, sorry, a little ahead of myself here. Now, I want to talk a bit about earnings. We're right in the middle of earnings season, okay? And most people, when we talk about earnings, they want to buy a position, an option position, just before that earnings announcement is released, okay? Well, let me show you why that's a mistake, okay? Let's flip to Alexian here. Now, at least on Thinkorswim here, which is the platform I'm using, when you collapse the option chains here, it gives you the implied volatility numbers here on the right. Now, what I want you to look at is that for every expiration, there's a number, okay? But if you look overall, you'll see more or less an average, which happens to be in around the low 40s here overall, except the nearest expirations here. You have this week's expiration at 91.85%. Why is that? Well, earnings are going to be released, I think it's Wednesday or Thursday of this week. So that's what tends to happen. The implied volatility tends to spike in anticipation of that earnings release. So the one thing you need to realize is that as soon as the earnings announcement comes out, this implied volatility number ends up going back in line with the average. Okay, so into tomorrow or Thursday, whenever these earnings are released, this will most likely be over 100%. Okay, so if as soon as the earnings come out, if it moves from low 40s, okay, that's almost 60% drop in your options premium. So it doesn't matter whether the stock goes up or down or stays sideways. No matter what happens, you're going to lose 60% of your value, of the option value, immediately, just after it's released. Okay, that's why a number of people will buy a call, for example, in anticipation of earnings. It caps higher, but they'll be puzzled as to why they're not making money. Well, that's because of that volatility crush. So one thing you can do is find stocks that have a record of moving one way or the other into earnings, okay? And make a note of that. In 2 or 3 weeks before the earnings release, check the chart and see if there is a valid setup with whatever strategy you're using, a valid setup for a trade in that direction. And with that implied volatility spike, okay, even if your position or the underlying remains flat for those next 2 weeks, just due to the implied volatility spike, your option premium will increase, okay? Calls and puts. So that is the right way to trade earnings. So not only do you have a shot at a move in your direction, like it happened here, but along with that implied volatility spike, that'll give your option premium a nice boost. But the goal is, remember, you need to be out of that position before the earnings release, okay? Because if you stay in it and wait for that earnings release, you're going to take part in that volatility crash, which means you're going to lose 60% of the value of your option immediately, okay? Let me show you another one that has earnings coming up. That's Nokia. I think it's also Wednesday or Thursday. Again, if you have a look at this, okay, the current expiration, this week's expiration, is already over 90%, where the average here, again, is in the 40s, okay? You'll see this over and over again. So have a look at that. Let's try to get in a couple more strategies here. Let's see. So the third strategy I want to talk to you about is protecting your portfolio, or even locking in profits using simple puts, okay? So going back to the Starbucks example, all right? One of the nice things is that a number of traders, they have a problem remaining disciplined and following their rules. In other words, when they get into a position, trying to manage that exit strategy or adhere to their stops becomes very nerve-wracking and very difficult to do. Well, if we were to buy Starbucks here and, again, buy that October put, that 60 put where we're only risking about 90 cents, okay, that is your stop. Okay? That is your stop. Anytime between now and expiration, you have that right to dump that stock at 60. Okay, so you don't have to maintain any other stock. You don't have to be watching it from minute to minute. Okay, it helps you relax, stay focused, and follow your strategy. Now, the other thing, though, the real nice part to this is that once it does move in your favor, you can actually roll this put up and lock in more profit. Okay, so if we look at this moving, let's assume that we've held this position for a few weeks and it's gone in our favor. Okay, and now we want to roll up to lock in more profit. Well, if you look at going from the 60, okay, say to the 65, all right, you're going to have to pay a premium to move up. But the difference is that the difference in strike prices is even greater than what you're going to pay to move higher. So as you pay up to move higher, you're locking in a higher strike that you will always have the right to sell your shares at. So you're locking it in, you're locking in that profit. That way, throughout the move higher, as the stock is gyrating back and forth, with every spike higher, you're locking in a higher profit level. And then even if it moves against you, you always have that right. But you also have the time. Okay, that's the real advantage. Remember, with most trades, you want to be out before those 30 days to expiry. Well, when you're holding a put long, you always have that right to sell it at that price. So you can actually hold through those last 30 days. You can hold for the full 80 days there because you're always protected by that put. Okay. Let's look at here. Let me give you one more strategy. Okay. Let me just bring up my presentation again. Okay, so now how can you generate a steady income from month to month, and especially if we are in, a quiet period in the markets or a consolidating period in the markets? Well, the nice thing about options is, remember, when we're selling options, we have that 80% chance of being successful right off the bat, because over 80% of those contracts expire worthless. So what you want to be doing, especially in consolidating markets, is selling premium. Okay, and one way you can do that safely is with credit spreads. Okay, in other words, if you sell one option, then you're completely, the term is naked on that option. You're exposed, because when you're long an option, you are the one who decides whether or not you're going to exercise that option. But when you're short, you're at the mercy of the person on the other side of that contract exercising that option. All right. So one thing you can do here, let's look at a few different examples. Number one, let's say we're trading KR here, and on this pullback here, we spot some kind of signal to go long, and we want to go long here. Well, when we have that signal, we can either buy KR outright, or we can buy a call outright, or we can sell what is known as a credit spread. Okay, and in this case, it would be a put credit spread. So you'd be selling a put and buying a lower put for protection, okay, and collecting that premium. Okay, so now I'm going to give you quickly, because I only have a few more minutes here, my rules of thumb when it comes to selling credit spreads and exactly where I put those on. What you want to do is you want to try to collect as close to 20% of the difference between the strikes in premium. In other words, let's say that here we were selling a put credit spread. Here we were going to sell the 37.5s here, okay, and do the 32.5s for protection. We're going to go 5 points wide. Okay, 37.5 to 32.5. Okay, so by selling the 37.5, we're collecting 90 cents. Okay, but to buy the 32.5, we got to pay between 10 and 15. Okay, so it's going to cost us about 75 cents. Okay, now the difference between the strikes is $5. What? 20% of that is $1. Okay, so what you want to do is try to collect as close to that $1 of premium for a $5 wide as possible. I would never go less than 10%. It's just not worth it. Anywhere between 10 and 20 is good, but closer to 20 is better. And the other thing is that once the stock moves in your favor and you're already in profit about 80% of that premium, in other words, if you collected 75 cents and you're within 80% of that, you want to take that off the table. You want to close that spread and bank that profit. That way you're not taking the risk that the stock does a quick turn on you and wipes out that gain. Okay? Now, the other thing is when you're considering putting a spread on like that, what I always like to do is have layers of protection between the current stock price and my short strike. Okay? So if I was going to put on a put credit spread here, the first thing I do from here is draw out the levels of support and resistance, the potential levels of support and resistance on the chart. And ideally, I'd like to have either 2 or 3 between the current price and my option strike. So the challenge will be to find stocks that will still give you enough premium if, for example, you're selling a put credit spread at this level in order to hide behind these 3 levels of support and resistance. Because what happens here, every time a stock moves into a support zone or resistance zone, it tends to either bounce around there for a while or bounce right off it. In other words, these act like walls in front of your credit spread. Another nice tool to use when it comes to that is the Ichimoku cloud, the actual cloud. This acts as support and resistance, identifies those levels nicely. So that's another thing you can use. Okay. Let me recap here a few things that we've talked about. Okay. So I know we've only had a brief amount of time, but the real key and the real advantages to trading options, first and foremost, is cost efficiency. Okay. You can trade them with a really small account, okay? But at the same time, you can really leverage them with a much larger account. Okay. They carry much less risk. Remember, the myth out there is that they're extremely risky. That's only true if you don't know how to use them. Once you do, they can be very, very safe. Okay? They can also give you much higher potential returns while you're spending much less. And not only that, much greater flexibility. If we had time to get into some of the more advanced strategies, you'd see just how many adjustments you can make throughout the lifespan of a position. But the real key, what we like to say is that you have many options with options. Okay. Now I noticed there's a ton of questions in the chat box, but before I get to that, let me tell you about a class we have coming up here, Friday, July 31st. This coming Friday, 1 p.m. I'll be teaching this class. It will be recorded if you can't make that time slot. But during that class, I'm going to show you how to create a steady weekly income using credit spreads. I'll show you exactly where to put them on, how to put them on, and how to adjust them should it go against you, okay? I'm also going to show you a way to use butterfly spreads where you can make 1,000 while risking only $90. In other words, with most butterfly spreads, when you use them this way, you're making about 9 or 10 times the amount of money you're risking. Also, I'll show you a couple of different delta neutral strategies that you can use to make money in any market condition, because with these strategies it really doesn't matter whether your stock goes up, down, or sideways. It's very, very neat. I'll show you those, and also how to use simple option strategies to repair bad trades. This is one of the most popular parts of the class. We'll spend a good amount of time on that. And together, we're also going to be searching for new trade setups coming up using any or all of these for the coming week. Okay, the link for this class is tradingwins.com/crush. But before you sign up, let me tell you exactly what you're going to get so you know that it's right for you. You will get, as soon as you sign up, as soon as your order is processed, which usually takes about half hour, an on-demand recording of the previous pro class we did, so you don't even have to wait till Friday. And you'll always have access to that. It's on demand. You can access it from anywhere. Regardless, we will save you a seat to the live pro class on the 31st. And in addition, we're going to throw in a 30-day membership to our pro service. Let me tell you a bit more about that, because it really is one of the best parts of this. Our pro service is the most powerful way to get access to all our systems. And you're going to also receive trade alerts showing you the entries, the stops, profit targets for any of the trades we take ourselves. You're also going to get premium nightly videos that show you how to trade the different systems that we have, and those are sent out every Sunday to Thursday evening. You're also going to get access to a members-only weekly chat. The next one happens this Thursday morning. They happen every Thursday from 10 to 11 a.m. Eastern. You get to come into our room, ask me any trading-related question you like. They're a lot of fun. And in addition, you can access our library of past educational sessions, and you can always reattend any of our pro webinars that you've paid for in the past. So it's an incredible value, and it's all yours for those 30 days. Now together, this package is $982, but we really want to show you what we're all about here at Trading Wins, so we're practically giving it away. It's only $47 for anyone on this webinar. Again, the link is tradingwins.com/crush. Okay, and this is everything you're going to get. Now, if there's, I believe we have a few more minutes, I'm going to bring in our coaching coordinator, Raul, to help me read off some questions. We're going to try to get through as many as we can. Raul?
It's always great to be on here. I see just from the comments in the chat box, people really loving this. What I think you'd call a bit of a crash course in options. Is that fair to say?
It is. It's actually more than a crash course. We have a very small amount of time. There's so much material to cover. It's hard to cram it all in 45 minutes. But at this class, the class is slated for two hours. It usually goes a lot longer. But the promise I'll make to you is that I'll stay as long as I have to answer all your questions.
I think the class that the folks are going to get on the recording was nearly 4 hours.
Exactly. Yeah, it was. It was nearly 4 hours.
Jack was asking, what does roll up or roll down mean?
So that's when, for example, you have that 60 strike. Let me bring up my charts again and show you. If we go back to the option chain here, let's say you had bought a 40 strike call or put on this option, and by rolling down, it means you're selling this one and buying a lower strike. Rolling up is you're selling this and buying a higher strike, and rolling out, as they say, means you're rolling from this current month, the October month, to a month, an expiring month that's further out. Okay, but we're going to go through several examples in the class where we're going to be adjusting trades, and I'll show you exactly how to do all of those.
I know you're going to be talking about credit spreads during the class on Friday.
Mm-hmm.
Nicole was asking, for credit spreads, does Vince have a general rule of thumb for risk reward?
Well, again, we're trying to collect about 20% of that premium. So when it comes to credit spreads, the risk reward is always against you. Okay? In other words, you're collecting about 20% of that premium. So if you're collecting $1, for example, to make it specific, $1 of credit with a $5 wide strike, you're looking to gain that dollar, but you have $4 of risk. Okay. The difference, though, what you really have to think about is that as soon as you place that trade, automatically you have about an 80% chance of success on that, because 80% of contracts expire worthless. So it may sound like, boy, that risk reward is completely against you, but it's actually in your favor.
Ted's saying he's a long-term investor trading mostly for his retirement account. How often does Vince trade leaps? You and I were having this chat just before the session started about Starbucks leaps.
Exactly.
How much do you trade leaps options?
Leaps, I trade them for a longer-term portfolio, and they're fantastic. They're great. I tend to trade leaps using monthly charts, but the same ideas, same strategies, same techniques apply to leaps as they do to the shorter-term options. So what I'm going to be teaching in the class you can use on any length of expiry.
Will says, just about to sign up for the session, can't make it on Friday. Will the session be recorded?
Yes, it will. So you're actually going to be receiving several recordings. Number one, as soon as you sign up, as soon as your order is processed, you'll get a copy of the previous recording, which, like Will said, is almost 4 hours. Then you're going to get the recording of the live class on Friday. But also remember, this comes with that 30-day membership. And during those 30 days, there's going to be 4 live market chat sessions. Those 4 Thursdays, those will be recorded and sent to you as well. So you're going to get a total of 6 recordings.
In the interest of full disclosure, what happens at the end of the 30 days to your membership?
Oh, if you're enjoying it, you don't need to pay at $97 a month. But if for whatever reason you'd rather not continue, just give us a call. We'll put a stop to it. We call it the world's easiest cancellation policy.
Leo's asking, does Vince play many straddles and strangles? I know you've got strong feelings on those things, especially for people that like to play them around earnings.
Yeah, I do not do a lot with straddles and strangles. I don't think the odds are in your favor with those. What I will concentrate on are the strategies where the odds are in your favor. And I'll show you exactly how I use them.
We had a question from Peter. I think we answered it on chat, but I'll just read it out for everyone who didn't see it. During the time that people have the pro service, as part of the pro service, is it just stock trades that you give out, or is it options trades as well?
Oh no, there's usually an option along with along with the stock. I almost exclusively trade options myself, so we're doing that. We also have signals on Forex as well. All of that. You'll get to see all of that. That's a nice benefit is you have those 30 days to test drive it.
I want to thank Daniel, Walter, Carlos, Bill, Jay, KJ, Ralph, and Jen for just signing up. Thank you so much. Looking forward to seeing you on Friday. KJ's asking, I haven't received my password for the pro service yet.
Oh, well, it takes time for your order to be processed. It takes about 30 minutes for you to get a welcome email, etc. And then I think it's a few hours later you'll get your user ID and password.
Linda says, can Vince talk about what's going to be different with the class on Friday than what he taught us today? By the way, thank you for that lovely teaching.
Well, I mean, there's...
other than it being almost 10 times, no, 6 times as long.
Yeah, no, that's the key, though, right? Today I was rushing through it and only gave you, a few tidbits that I can fit in. I'm going to be going through these strategies in detail, along with others like the butterfly strategy and the delta neutral strategies, in detail with several examples. So I'm going to show you exactly how I would set those up. And a real key is how we would repair them if the trade goes against you. Okay.
Bonnie's saying, how much of the discussion will be on simple option strategies and how much will be on complex option strategies during Friday's class?
Best way to say it is, whether they're simple or complex, I'll break it down for you, make it simple for you to understand. So by the time you walk away, you're going to know exactly how to do this on your own. Most of the time will be on calls, puts, and credit spreads, but we will get into, like I said, the more sophisticated strategies.
Marjorie says, hey Vince, great session. Thanks so much for that.
You're welcome.
I'm trading with a small account. Not sure if this system will work for me. Will it?
Yeah, it actually will. It'll very much work in your favor. The one thing I absolutely love about options is that you can really limit your risk. And when you have a small account, that's what you need to do. You need to be able to trade in a way that you can live to trade another day. And I'll show you, just how small of a risk you can take, even with a small account.
We've got to go shortly. I just want to ask you one final question. What do you use options for mostly? Is it for managing risk or is it for speculation? Or would you say it's a 50-50?
Yeah, it's a combination. It allows me to speculate without worrying about blowing out my account. So I really limit my risk without necessarily capping my upside. That's what I love about it.
Times sure have changed from the time that you started trading options. There were maybe 100 optionable stocks.
Oh, I know, and now there's thousands.
4,300 at last.
And that's just equities. But
that's just
futures
equities in the U.S.
Yeah,
market.
And now from an option selling perspective, now we have the weekly expiries, which has really changed the whole field. So it's pretty
exciting changes. TradingWinds.com/crush to join us for the class on Friday. It's $47. You got a lot of stuff. You got a month of membership. You got almost a 4-hour class recording of the previous class. More.
Yeah, like I said, we're practically giving it away, but we'd like to give you a chance to show you what we do here.
I got a comment from a client that called today. She said she's watched that class 3 times already.
That's great.
That. Folks, thanks so much for joining us today. Vince, I'll let you have the last word.
Thanks again for being with us, everyone. I was glad to be able to be back. And a great thank you to Reed and everyone else at Investor Inspiration for having me back once again. On that note, Reed, I'll pass it back to you.